My name is Nav Athwal. I'm the CEO of RealtyShares. It's a crowdfunding for real estate platform. We've been around since around June, and we've funded about $500,000 worth of transactions through our platform during our beta. So I'm going to take a little different route than the prior speakers and really talk to you about crowdfunding, its current state, its past state, and what I think will be its future state, before getting into RealtyShares and telling you a bit more about what we do. So this is just a timeline of kind of where we've been and where we're going with crowdfunding. We really started crowdfunding with the term being coined. And prior to the term being coined, crowdfunding had been used successfully. The earliest date of crowdfunding use was really France's construction of the Statue of Liberty. Well, let's fast forward in the early 2000s when we had rock concerts and bands come together through the use of crowdfunding. And in 2006, the term crowdfunding was actually coined. From there, we saw in 2009, Kickstarter was founded to fund creative projects, rewards and donation-based crowdfunding. No securities regulations involved there, purely reward-based and donation-based crowdfunding, where there's no investing taking place, does not involve with securities. And then in 2012, we saw something very monumental. Since the 1929, 1930 crash, we hadn't seen any sort of we've seen changes, but nothing as monumental as what was the Jobs Act. Various provisions in the Act that would change the way we invest and view companies, real estate, anything outside the publicly traded markets. But the law came down, nothing really happened for a while. And then in 2013, we finally saw some action from the Securities and Exchange Commission, which is the agency in charge of regulating and administering the 1933 Act as well as the 1934 Act. So that's kind of where we've been, where we're going with crowdfunding and securities regulation. So there's really, in my mind, there's three types of crowdfunding or three types of peer-to-peer investing. And I kind of mingle those two things together because it's community-based, it's consumer-based investing or lending or pleasure. So debt is really growing. I mean, if you've been on the internet and you've invested, you've probably heard of Lending Club, Prosper, as well as Funding Circle. And these two, mainly Prosper and Lending Club, are now doing close to $1 billion worth of loans per year, which is insane. I mean, it's really, you're lending somebody money to go pay their credit card debt off. I mean, wow, it's crazy. How they grew that number, it's really a lot of institutional money flowing through those platforms, even though it doesn't seem like it is. They make it seem like peer-to-peer, but there's a lot of institutional money going through that platform that funds a lot of the loans on those platforms. And then there's the rewards-based crowdfunding, Indiegogo, Kickstarter, and those platforms are obviously growing as well. You've seen celebrities use them to fund their projects. We've seen people sell watches, video consoles. It's insane. I mean, we've all probably either used it to pledge or used it just to browse what's on the internet. So the two leading platforms, Indiegogo and Kickstarter, have now crossed near $1 billion worth of pledges through their systems. That's, again, a very insane number given the fact that they were only around since 2009. And then finally, we have the third type of crowdfunding, equity-based crowdfunding, kind of born out of the Jobs Act. Not really because, as I'll explain in a little bit, accredited investors could already invest in internet platforms, but I think this really created a surge, the Jobs Act, and we saw over 500, I'm sure the number is much greater now, platforms really come to be to kind of tackle these markets in various verticals, including startups, consumer goods companies, real estate. It's just been insane. And what's really interesting is, the Jobs Act came down in April of 2012. The final rules of Title II, which would allow you to publicly solicit your investments, was supposed to come down in July 1st, 2012. And the crowdfunding legislation, which would allow anybody, non-accredited investors, to invest in startups and things on the internet, was supposed to come down on January 1st of 2013. So fast forward, we're definitely not there yet. Title II came out almost a year and a half later than it should have. But we did see states start taking action. Forget the federal government, they're slow to act. Let's start creating our own versions of crowdfunding legislation. And the two that have already come down with their own versions are Georgia and Kansas, with North Carolina and Washington having teed up their own versions. So what's exciting is you see that there is this need for crowdfunding, and the states see it themselves, so outside of the federal government. And the burdens to actually, so when you're selling a security, you either have to register that security, which is filing an S1. Any company, like Twitter, for example, filed an S1 before they went public, or you're exempt from filing an S1. So the most widely used exemption for private businesses is Regulation D Rule 506, which lets you sell, but you can't solicit your offering, and you mostly have to limit your investors to accredited investors, those making $200,000 or more, having a net worth excluding their personal residence of $1 million or more. But what these states have done is created exemptions for intrastate offerings, meaning not only do the investors have to be from the state, but the substance of the offering must also be located within the state. They've allowed non-accredited investors to participate through advertising. So it's just something we've never seen before happening in these 4 states. And hopefully it will propel other states to take action as well. So fast forwarding to Title II, which a minute ago I just said, if you're doing a Reg D Rule 506, you cannot advertise your offering. You have to keep it on the hush hush. It's like being part of a secret club. However, the Title II Act that was promulgated on finalized on September 23rd, 2013, now lets you actually go out and solicit, advertise. Tell the world you're raising money, and tell the world what the terms of that raise are. It was a long process to get there. As you can see, April 5th, 2012, the Jobs Act comes down. 2012 of July is the deadline. 15th, that should be, yeah, that's right. The proposed rules come out, and almost a year later, we see final rules that go into effect. So you would think any startup, for example, AngelList is a big one, Funders Club, others would be jumping to use this regulation. But AngelList is using it. They are using public fundraising, and there are a few others as well. But a lot of crowdfunding platforms or portals are not using this Title II. And I have my own assumptions as to why that is, but there are very severe consequences if you use Title II inappropriately. So when the SEC came down with these rules, they also came down with proposed rules that basically said, okay, yeah, you can solicit and advertise, but if you do it incorrectly, we're banning you from using Reg D 506 for an entire year. If you're a startup, that's like the guillotine for you. You just can't do it. You need to raise money quickly and be able to have as much flexibility to do it. So that stick was enough to cause a lot of platforms to say, we're just not going to take that approach. And there are other burdens that Title II propelled as well, but that was the main one, the scariest one for startups, that resulted in a lot of platforms now utilizing what would seem to appear to some to be a monumental change. So getting past Title II is Title III, which is the holy grail of the Jobs Act. The Title III crowdfunding legislation. Non-accredited investors can actually purchase securities through online platforms that sell securities and earn a commission. So that was, again, supposed to come down on January 1st, 2013. Or 2013, nothing happened. We finally saw proposed rules come down on October 23rd of this year. And it's probably going to be about a 9 to 12 month period before we see anything final. These are just some of the burdens that, or the provisions within that act. As you can see, there's a maximum investment, which is based on your income or net worth. There's also various financial auditing and review requirements based on how much you're raising. So bottom line is it's not going to be easy to use this in a cost-effective manner. So moving past the regulatory framework, and you probably think we're crazy to be venturing into this uncharted territory, but we've created a platform to allow accredited investors, so we are limited to accredited investors today, to invest in real estate investments online. So, is that computer online?
Yes, please.
Okay.
Yeah.
Cool, because I'm going to demo the product towards the end, but I think we're okay now. So essentially what we do is we pre-vet and find real estate investment opportunities, cash flowing opportunities, multifamily, office buildings, retail centers. We list them on our platform and open it up to our community of accredited investors to view, browse, and invest in them through our platform. So it's basically creating a way for investors that have historically had a very difficult time accessing this very inefficient asset class to invest as little as $5,000 into any specific investment opportunity. That's the team. I'm the CEO, like I said. My background's in law as well as real estate law as well as securities. My co-founder, private equity, and then we have a tech team of 2 engineers. So how does the process work? When we get a lot of inbound leads for people looking for capital for a real estate project, they apply through an easy application to our platform. Once we get their application, we essentially conduct a background and reference check on the principals of the company looking to raise capital. Once we feel comfortable they're not fraudsters or looking to raise money for the wrong kind of project, then we really look at their strategy and their pedigree. Are these professional real estate operators or somebody that saw flip my house too many times and decided they want to flip houses in San Diego? Then we underwrite the investment using proprietary methods. We have a team of underwriters that have been in real estate private equity for decades that help us really look through these properties and say, do the rent projections make sense? Do the returns make sense? Do the IRRs make sense? So we have a very conservative approach to what we allow on the platform. That's it. So I'm going to just demo the product for you. I have 4 minutes. That should give me enough time to really run you through how the process works for an investor. Sure. So essentially, we have a very simple sign-up process. We're not going to take you through that. I just want to show you how the investment process works. So, Eddie, if you click on the login button there, the email is nshwal@gmail.com. So this essentially is how you can browse the different deals on our platform. Eddie, why don't we invest in the second deal there, the 301 Country Landing? Yes. So actually, go back to investments, Eddie. I just want to show one quick thing before we get that. Yeah, just go on more info there real quick. Click on the more info there. Yeah. So essentially on any given deal we put up, we have a variety of information so the investor can accurately determine if the investment makes sense. We have an overview of the property, we have a funding goal for each investment, similar to a Kickstarter funding goal, property details, photos, this is a debt offering, so we do both debt and equity. So there's borrower information as well as legal documents. So now, let's say we've reviewed everything, we like it, we want to invest in the property, we just click the invest button. So you got to browse down a little bit, Eddie. And so you got to, basically fill out some information. Let's say Eddie wants to invest $10,000. You want to take title in your individual capacity. We do support LLC, self-directed IRA, as well as trust investments. Brian Smith, okay, sounds good. Everything looks good. Let's click continue.
Is there a minimum?
The minimum is $5,000.
Okay, and is there a maximum?
No maximum. So this is our accreditation questionnaire. Essentially, we want to verify you are an accredited investor. So here, it looks good. We all look good. The employer name is associate and the current position associate. That's kind of weird. But everything looks good because, like I said, the accreditation test is either or. Either you make more than $200,000 or you have a net worth of $1 million. So in this case, my net worth isn't great, but my income's awesome. So let's go down. Let's verify the 3 verification steps. I'm 18, sufficient knowledge to invest. Verify everything is above is correct. And then we just have a verification step here just to make sure everything looks good. You just want to verify it because we use this information to pre-populate legal documents, which is the next step. So in this case, everything looks good. Let's click continue. And we can just click review document there. Essentially, these are the legal documents. This is the way we memorialize your rights in the investment. So you got to review these, click start, Eddie. Essentially sign there. It's just a dummy account. Confirm signing, which means you've signed, you've reviewed, everything looks good. And then we take you to the final step, which is getting your money into our account. So there you see anywhere to select account, just click on that. Pick the Wells Fargo account that's already been linked. Click invest, it verifies that you need $10,000 and you're done. You go back to your dashboard and you'll see that the investment, you click go down a little bit, it's pending because the bank transfer takes about 2 to 3 days. So that's pretty much it. It's taking real estate investing, a country club model of who knows who, and really shifting into this very efficient online process where you can not only due diligence the investment, but also invest in 4 steps, essentially. So that's it. Sorry the demo takes so long.
I'm interested in seeing a demo about how you've underwritten this investment.
That part we don't demo. I mean, I can tell you how we essentially do it.
Well, all right, so may I ask a couple of questions about this?
I think Brian has
Sorry,
the
go ahead. All right, so are you I thought you were taking seasoned cash streams or income streams, and now I'm seeing what looks like a flipper for a house.
Yeah.
House, so I'm confused.
So, yes, we're looking for seasoned principals or companies that are doing the investment project. So in this case, yes, the flipper we're working with here had done about 20 flips in the same market we were focused on. Had a really good track record. None of their flips had ever gone bad. We reviewed the market, we looked at the market, we looked at their history, we did the background checks. We felt very comfortable that they were going to actually be able to successfully flip the home and exit the investors on their
Okay,
debt.
so this is my confusion, because I thought you said that you were looking for income investments, and this sounds like more of a commodity flip investment. And so which are you?
So when I say income, I mean something that's, so when, you know, all the entitlements, like basically taking raw land and developing it into a building, right? There's about, and I was a land use attorney, so I know exactly how it works, is 3 to 5 years before any sort of income comes back from the investors, because you gotta go through the entitlement process, and you gotta go through construction, then there's either a sale or you stabilize the asset and you start getting cash flow. But a debt instrument pays interest on a monthly basis, so you're getting income into your bank account as an investor in this investment. So yes, on the equity side, we deal with only commercial cash flowing rented buildings, apartments, offices. But on the debt side, we do shorter term flips where there's interest on a monthly basis being paid, but essentially it doesn't mean there has to be a tenant in the building.
So for equity, if I'm building an apartment house, no way to get equity, but if I have an existing property that has a seasoned income flow, then I can something.
Yeah, we don't do construction lending. We do essentially fix and flip rehab lending or longer term lending. And on the equity side, yeah, it's cash flowing property, so it's not anything that you have to still construct or get approvals. Sorry, I wasn't clear about that.
Okay, quick question with regards to interest. Who takes the deduction on that?
It's passive, so it's an LLC structure. It goes through to the.
So do you pass through a pro rata amount of the interest?
That's exactly right. So essentially, if you were, there was a $100,000 total loan, you had a $10,000 stake, 10% of the interest would come as a 10% of the LLC.
Is that a choice of yours, or is that just to make it easier?
That's just legally how it works, because when you participate in a debt or equity investment, you choose how much you want to invest. You have an interest in the LLC. That's how the investors are syndicated. And then whatever your interest is, that's what you're paying based on.
How do your fees compare with other sources of equity or debt?
We're on the debt side. Are you familiar with hard money lending? Basically, we're actually quite a bit cheaper than hard money. I mean, on our interest-only loans that are less than a year, we're about 8 or 9% interest annualized, maybe a couple points up front. On equity, most of our cash flow comes from the our fees come from the actual cash flow of the property.
So help me, let's have an example. $10 million apartment building, we're raising $4 million in equity to break even institutional conventional loans. So I need $4 million. What's it going to cost?
$4 million equity. We would probably take, and you're the person seeking capital, probably a 1 to 2% upfront fee is what we charge. Plus we take about 1% or 1.5% in a management fee from the income of the cash flow over the whole period. So if it's 5-year hold, we take another 1 to 2 points on the management fee.
So it's 1 point to raise the money and another 1 or 2 per year?
1 to 2 points to raise the money, and then another 1 or 2 from the cash. That's right.
So if it's a 5-year hold, that's 12%?
It's actually lower than 12% because a portion of the fee is not charged to the capital seekers, it's charged to the investors because you make a distribution of cash flow. We take a small off-the-top fee before we net the distribution to the investors.
Is your fee then worked back into the raise so that it becomes now $4.5 million?
No, no, not the upfront fee. No, it's paid separately by the sponsor. The cash flow fee is from the investors, so it's off the top. It doesn't affect the person raising capital at all.
So the fee is coming, so you get, I'm sorry if I'm bothering you guys with this, but some money is coming from the person wanting to raise the money, the
Yes,
sponsor.
yes,
And that's 1 or 2 points.
yes,
And then there's 1 or 2 points, which is more or less a management fee.
from the investors.
Yes.
Yes.
Thank you.
Yeah, I have a much less technical question. I'm just wondering about like supply and demand. I mean, I can definitely see the value as, let's say, I don't want to, as an accredited investor, I can really pick a lot of different properties, invest 10,000 here, 10,000 there, etc., etc. But I just don't understand from like this, from the supply side, like what's the demand for using crowdfunding to actually raise money to buy a piece of real estate, when it seems like every single bank is just trying to compete so eagerly for that kind of business.
So, yeah, there's 2 questions there. One is on the debt side. The type of projects, for example, a short-term rehab loan where there's no tenant, banks do not lend on that kind of product. I mean, you could go after hard money lending, which is going to be a lot more expensive, but banks just don't lend on that because the term is too short. There's still rehab work to be done. It doesn't meet their underwriting criteria. Also, if you've done a lot of projects, say you're somebody who's a seasoned property operator and you've done 20 projects, banks look at you as a liability. Okay, this person's done 20 projects, they have a lot of debt outstanding, maybe you have loans on 8 of those properties. They don't underwrite you and approve you, and I've done it myself, so I know that. Whereas someone like us would look at them as, okay, this person's very seasoned, knows what they're doing, so yeah, if it's a 6 or 12-month term loan, we would look at that because they've had a really good track record, regardless of how much debt they have outstanding. Obviously, we don't want the debt to make sure that it's exceed a certain limit, but we do look at that more holistically than a bank would. On the equity side, raising capital is extremely inefficient. Raising capital for someone who's doing about $2 to $20 million deal sizes, it's really knocking on doors, calling everyone you know. It could take up to 40 to 50% of your time raising capital rather than actually focusing on the project itself. So we make the process completely streamlined for that person seeking capital. We syndicate the investors into a single fund. That single fund becomes an investor in the deal. So it's time saving, it's efficiency, it's access to a new source of capital. If you're a real estate person, you're always looking for more capital, because more capital means more deals. So to sell on the deal side has been very easy. Finding the really good deals has been difficult.
So if I understand, so this is basically what you're talking about, like building an income stream from this type of investment would be to spread your investment across a large number of 6 months peak projects.
That's one type of project on the debt side. On the equity side, it's usually 3 to 7 year income producing properties like apartment buildings, office buildings, retail centers.
Okay.
Sorry, I just had a question. Well, I guess the first question is, are you a similar product to Realty Mobile?
We're a better product.
Well, no, but can you talk, I mean, that's
Sure, yeah, no,
can you talk to that, just so I get my 2 questions, can you talk to that? And then also, it sounds like you kind of a segment of your population you're targeting new investors, at that $5,000 entry point. I mean, are you guys investing in these funds too? Like, how can people decipher from all of this? When you see the return is not totally guaranteed, like, how do you know which property to invest in? Like, is there guidance? Can you talk a little bit?
Sure. So Realty Mogul, they are a similar type of product. However, I think our focus on the asset types is a bit different than Realty Mogul, as well, not only geographically, but also type of product. So we're very focused on 4 commercial assets: apartments, retail, and office buildings. And we're also focused on different geographies, but that's not the biggest differentiator. It's really we're focused on those 4 product types. Realty Mobile does things like storage, mobile homes, blind pool funds, whereas we are focused specifically on a specific asset. So you are investing through our platform, you know exactly where your money's going. It's not put into a pool, then that's deployed into different assets. So that's the biggest differentiator. If you're an investor, we do have certain integrations in our platform that allow you to determine
what investment type you want to invest in over another. Mainly is, look, you're somebody who has limited capital, maybe you have $50,000 and you want to deploy it in 3-4 deals. Offline, you have to put that entire $50,000 into a single deal. No one's going to accept a check less than 50 if they're raising money, unless they're stupid or they're really desperate. So what we do is we essentially provide asset types of varying maturities, varying risk and returns, varying geographies, and provide a lot of data to the investor on the geography, where rents are going in that geography, why is there an employment base there. So as you an investor, if you wanted to put $50,000, maybe you put some in short-term debt, to ensure quicker to get your money back. Maybe you put some in 5-year apartment buildings in Texas because the yields were higher. Maybe you put some in the Bay Area where yields were lower, but you knew there was a really strong economic base, and that over time the asset value was going to increase. So we just provide as much transparency there. We don't provide investment advice. We don't recommend investments. We just provide as much information in a very succinct format so that you can assess that for yourself. And a lot of our investors are not first time. We have Google people investing that have invested before, Facebook engineers, retirees, self-directed IRA owners. The beauty is, even though they invest in real estate before, they've never been able to deploy $100,000 across 10 assets, thereby getting the diversification we can get off. So that's been the biggest selling point.
Do you handle the returns? Do you process the returns?
Do we process the returns?
No, after 5 years or whatever, to get the money back. Do you guys handle that?
Yes, yeah, we have a payment system integrated, so all the money that flows from the company to the investors goes through our system. We've already paid back our first investment in full. The return that was projected was met. The next one should be paid back next month, so people are seeing their money back as well as returns. All of our assets so far are performing, so everything's been according to plan.
Okay, now comes the
Thank you.